That's a question I suspect that you need to ask your prime minister. Yeah. My preference, would have been 10 or 15 years ago. When I emigrated to Canada from the United States, if you look back to the tin trade, the nickel trade, when the dealers get too far offside, what's going to cost them on their balance sheet? Force majeure, suspend the contract, cash settle, drive on.
So we're going to see a couple more halts here, technical glitches,
Yes.
I'm sorry?
That's insane. Yes, probably. Yeah. I mean, understand the beast for what it is. Yeah. There's great advantage coming. If you keep your head and you play the game just with the facts at hand, as opposed to exaggerating that in your own mind, you're going to do very, very, very well. Yeah. If you make mistakes in a market like this, it's tragic. There will be a lot of people who conspire to lose money in this market. Yes. Which is, I think, an enormous mistake. First of all, I think the conventional measures of inflation are lies. If your listeners will do the simple thought experiment and look at the basket of goods and services that they consume and take it back to 2020 and ask themselves whether housing prices or rents in Canada have been increasing at 2.5% compounded or some higher number, or their gasoline, or their tax bills, or their groceries. The idea that inflation is correctly measured by the CPI, which is to say 2.5, 2.6%, causes good commentators to call it the CP lie. Yeah. My suspicion is that the deterioration in the purchasing power of our currency, which is what I characterize as inflation, I think that number is closer to 8 or 10. I think it's a much bigger number than people give it credit for being. I would challenge your viewers to put themselves to the test. Look at the basket of goods and services that they acquire and look at what those price levels were in 2020 and look at what the price levels are today and ask themselves whether the number that you're being quoted by your government is accurate or fallacious.
A growing debate is emerging about whether Canada can remain competitive in global resource investment. Critics argue that heavy bureaucracy and slow policy decisions have discouraged investment compared to other countries. Historically, Canada once attracted strong capital flows, thanks to policies that favored investment and development. Over time, however, tax structures and regulatory frameworks have shifted, creating obstacles for businesses trying to build major industrial projects. Today, investors often compare North America's rules with those in other countries where capital expenses can be recovered much faster. These differences influence where companies build mines, factories, and processing plants, shaping the future of global resource development.
Sadly, I think most people don't want to confront bad news. If they do, they'd be forced to act on it. And most people would prefer that their problems were solved by others. And people still, unfortunately, on both sides of the 49th, believe that the government is the right place to solve the problems. I think the government causes the problems. I would prefer that your listeners, rather than wait for Carney or Trump to solve their problems, think about solving them themselves, but they need to confront them first. If you believe that inflation is at 2.5 and you get paid 4.2 or 4.3 at a US 10-year treasury, you're fairly sanguine. If rather than that, you think that you're getting paid 4.2 in a currency that's depreciating at 8% compounded, you think, uh-oh, I have to do something about this. Sadly, too many people don't want to take control of their financial future. That's a question I suspect that you need to ask your prime minister. My preference, would have been 10 or 15 years ago. When I emigrated to Canada from the United States in 1970, this country had a lot of common sense. You didn't go to war in Vietnam, as an example, which was a huge benefit to me. But there was, at that point in time, a very, very investment-centric tax code as opposed to a consumption-centric tax code. That's all changed. What pace of change would be appropriate for Canada needs to be decided not by an American, but rather by a Canadian.
Performative politics, perhaps?
Well, I would just ask Canadian taxpayers to think about the well-being of their children. I would ask American taxpayers the same. We, in the United States, we have a ridiculous tax code. Did you know that if you and I went to build like a mill, a tilt-up concrete building in China, we would depreciate the capital cost in year one. In other words, we would expense it. In Canada and the United States, it would be straight line depreciation at 3%, so 33 years. And in communist China, we would expense that. Now, where do you think people are going to build? Think this through.
One surprising example of global competition involves how countries treat capital investment. In some nations, companies can deduct the full cost of building industrial facilities in the first year, dramatically lowering the financial risk of new projects. By contrast, businesses in countries like Canada and the United States often depreciate those same investments slowly over decades. That difference may sound technical, but it strongly influences where corporations choose to invest. When investors compare tax policies across regions, they tend to favor locations that reward risk-taking and long-term development. As global competition intensifies, governments must decide whether their policies encourage growth or quietly push capital elsewhere.
I guess I'm too close to the silver market. The first silver squeeze, I was still at Sprott. And the Sprott Physical Silver Trust was adding assets like crazy. We had to go buy silver. We had some hairy moments, not because of the market, but because our own buying was so heavy. But there was never a squeeze in wholesale silver product. The circumstance that we have today is, in terms of good delivery retail product, 1 ounce product, even up to 1 kilo product, it's short. There is no shortage of institutional product. There's no shortage of good delivery for people like the Sprott Physical Trust. There is a shortage of good delivery on deposit of COMEX. If we can get through the next 3 or 4 months, that solves itself. The dealers are reluctantly buying back non-good delivery silver, shipping it to the refineries, and it reappears as good delivery. In the interim, the circumstance that we have is that the outstanding paper contracts greatly outweigh the amount of silver available for good delivery. Now, the silver squeeze people need to understand the way the exchanges work. The exchanges are owned by the members. The idea that you will ever actually catch them physically short so that they get bought in for cash will never occur. The exchange will declare force majeure. They'll cash settle. They'll halt the contract. They'll cash settle, wipe their hands and go away. The idea that you're going to catch JP Morgan Chase or Conti or any of these guys physically short is nil. It's a non-starter. It will never happen. If you look back to the tin trade, the nickel trade, when the dealers get too far offside, what it's going to cost them on their balance sheet? Force majeure, suspend the contract, cash settle, drive on.
So we're going to see a couple more halts here, technical glitches, I'm sorry?
That's insane. Yes, probably. I mean, understand the beast for what it is.
In recent years, social media discussions about a potential silver squeeze have attracted significant attention. Some investors believe the paper trading system for silver could collapse if too many people demand physical metal at once. However, experienced industry participants argue that the situation is more complex. While retail products such as 1 ounce coins may occasionally face shortages, large institutional bars used in global trading markets remain widely available. The real issue lies in the imbalance between paper contracts and physical supply on exchanges. If pressure becomes too great, exchanges typically halt trading or settle contracts in cash, rather than allowing the system to fail.
I've watched India for a long time. They don't have anything like permanent policy. I remember some years ago when the Indian government put a big excise tax on gold. I had some friends who were Gujaratis, and they were, well, I would call them traders. The Indian government would call them smugglers. And I asked them about that circumstance, and they said, well, we hope the excise tax continues. And I said, well, why is that? They said, well, it costs us 2.5% in bribes to land the gold in India, and there's a 15% excise tax. And they built us in 12.5% margin. These are exciting times. And, my suspicion is, we've talked about this before, given the likelihood of the deterioration in purchasing power for the US dollar, and by the way, the Canadian dollar for 10 years, I think if you look over the next decade, the gold price, at least the nominal gold price, will do well. I don't think that the pace of increase will rival the pace that we enjoyed in 2025. So the listeners that you have who believe that the gold price will double in the next 12 months will be needlessly disappointed. Let's say it went up 10% or 15%. Let's say, too, just for fun, believing like Eric Sprott, that the gold and silver companies discount fairly substantially the current price of gold and silver. If gold and silver just went sideways, The stocks need to go up to catch up. So there's lots of room left in this market, assuming that your listeners don't have overinflated expectation. I think that's the important thing. I think don't lose your head about where we are. There's great advantage coming. If you keep your head and you play the game just with the facts at hand, as opposed to exaggerating that in your own mind, you're going to do very, very, very well. If you make mistakes in a market like this, it's tragic. There will be a lot of people who conspire to lose money in this market.
Despite short-term volatility, many analysts remain optimistic about the long-term outlook for gold. Over the past decade, inflation and currency depreciation have slowly reduced the purchasing power of major currencies, including the United States dollar and the Canadian dollar. In this environment, precious metals often attract investors seeking protection against financial instability. While some market enthusiasts expect gold prices to double quickly, more cautious analysts believe steady growth is more realistic. Even moderate price increases could significantly benefit mining companies, especially if their stock prices currently undervalue the metals they produce.
Well, the customers right now are superb customers. For your listeners who don't know, our bank, Battle Bank, among its premium product lines we will allow you to access the credit that you have in your stack. If you've been storing gold and silver, you need working capital for your business, you need money for a down payment on a triplex or something like that, we will loan you money against your gold and silver. For three reasons really. Gold and silver, first of all, are very good collateral. If you don't pay me, I can liquidate you in 10 seconds, 24/7. Right. The second thing is, for whatever reason, they've been out of favor for so long that there's no competition in that space.
Just central banks.
Which is wonderful. The third thing is, in my experience, the people who buy gold and silver, in addition to the fact that I know them, I've been talking to them for 50 years, are pretty prudent. They're the kind of people you would want to lend money to. So the loans we've made so far are, as an example, a home builder who owns $10 million worth of bullion and occasionally needs $2.5 million to
capital
for a subdivision. He finances out with a construction loan, but he or she has a need for 9 months for 2.5 or 3 million. Perfect. Perfect borrower. It's been a dream product so far. What you say is true. For the first time in 20 years, we've sold out the live portion of the conference, which is wonderful. We have basically infinite capacity online. So people who are interested can go to rulesymposium.com, or better yet, link through the Kitco page and see us there. That conference, unlike any other conference I know, comes with an absolute ironclad money-back guarantee. If you attend the conference and you don't think you got your money's worth, we'll give you your money back. Now, the other thing that people need to know is, although the conference lasts only 4 days, it's 46 hours over 4 days. It's extremely intense. What that means is that you will likely need to avail yourself of the recordings after the conference to refresh your memory on things that might have slipped your mind. And then the last thing is that I personally interview every speaker and every exhibitor at the conference before the conference, so that you arrive at the conference knowing what you want to hear, so you can allocate your time more efficiently. If you go to Rule Investment Media YouTube channel, what you will see before the conference, whether frankly you attend or not, are all those interviews. They're all absolutely free. But it's important to note, to get your money out of the conference, A, watch the pre-conference interviews, B, watch the conference, C, play the tapes to hear what you missed.
Another emerging trend is the use of precious metals as financial collateral. Some financial institutions now allow investors to borrow money using their gold or silver holdings as security. Because these metals are globally traded and highly liquid, lenders can easily sell them if borrowers fail to repay their loans. This model allows investors to maintain ownership of their metals while still accessing cash for business ventures or property investments. Interestingly, many lenders believe precious metal investors tend to be financially disciplined clients. As a result, this niche financial service is gaining attention as a practical bridge between traditional banking and hard asset investing.
Well, that is what it's going to be. At some point in time, I shed my mortal coil. And It is precisely a legacy. That's what it's all about. Hopefully, when that time comes, the enterprise, which is the publishing business and the conference business, the people who now are employees, will continue that conference on. It's precisely a legacy. Money ultimately is made in the delta between the price you pay and the value you receive. The value might be anticipatory. In other words, it might be that the value isn't present now, but you can see over 3 years or 5 years how the management team could add a lot of value. The delta between the price and value is where money's made. The second thing among the juniors is human capital. It's all about the jockey. And the jockey needn't merely be a success. The jockey needs to be a success at the task at hand. If the jockey was a success operating a gold mine in French-speaking Quebec, and the task at hand is exploring as opposed to operating in tertiary volcanics for copper gold deposits in Spanish-speaking Chile, the success isn't necessarily appropriate to the task at hand. So it's important that the speculator understand that the management team has to be successful, but that success has to be appropriate. The third thing is that the management team has to have a plan to add value that you understand. I ask every exhibitor here that I talk to, and there'll be about 100 this year, tell me the most important unanswered question in front of you. Not what your ultimate goal is, but tell me the interim step that increases the market's understanding of the value of your project. 80% of the time I ask that question, the management team can't answer it, which is to say they don't have a plan. Now think about that. How are you going to get somewhere without a plan?
Looking ahead, analysts believe certain commodities may become increasingly important to the global economy. Uranium demand could grow as countries expand nuclear energy to meet climate and electricity needs. Meanwhile, copper is becoming essential for modern technologies, from renewable energy systems to electric vehicles. Industry experts estimate that the world's largest producers may need to invest hundreds of billions of dollars just to maintain current copper production levels. One influential mining entrepreneur, Robert Friedland, has long argued that copper shortages could become a defining challenge of the energy transition. If demand continues rising, the next decade could bring major shifts across global resource markets.